disclaimer, my views don't necessarily represent the views of JPMorgan. I don't know how I would possibly represent the 538,000 views of my 269,000 colleagues. And just to make sure I'm covered, these views may not even represent my view. So, in this age of personal responsibility. So, I've been kind of intrigued by some work that a fellow at Booth School in Chicago has been doing. You might have picked up an interview he did with Bloomberg today. He's pointed out, interesting thing, he's pointed out in a recent paper that when faced with policy questions, economic experts seem to provide answers very different than those of the average American. And his explanation, economists tend to answer these questions literally and take for granted that all the embedded assumptions are true. Average Americans do not. So I find this an interesting observation because it's been my sense all along in all the big national debates that this issue kind of distorts, plagues the big debates about the big issues that we have on the economy. And here's what I'm thinking about. It's true that trade imbalances are a signal that something's out of whack if you're living in a textbook. But when the sleeping, impoverished giants wake up, and that's the reason why trade deficits are blowing up, that's the face of an economic miracle. That's not the source of economic instability that we learn in school. It's true that when the Fed is trying to guide the economy, it buys assets to create reserves so that the banks will create credit, and that turns into money. But the truth is that what the Fed is doing now has nothing to do with anything that we learned in school. It's not treason. It's not the Weimar Republic. It is an effort to try to bring long-term interest rates down, and we'll talk a little bit about that. But it's certainly not creating money, therefore it can't be an inflation issue. We should know that when we see the accumulation of excess reserves to the tune of $2 trillion. It's true that budget deficits matter, but what matters is structural deficits, not cyclical deficits. The cure for a cyclical deficit, what we have today, is to get the economy back on its feet. You won't make much progress on the deficit if you think you can do it by cutting spending, raising taxes. What we really face, the problem we face, the structural deficit is what you care about. A structural deficit means something's out of whack, and even when our economy gets back to full employment, there's going to be a problem. The problem is we don't have a structural deficit today. We will have a structural deficit down the road. That is the issue, and it's all about health care, about entitlement reform. And that's why, from my perspective, you think about, most of you probably think this is so dysfunctional what's going on in Washington. From my perspective, watching from afar, I really think something important is taking shape, and I'm fairly optimistic about where we're going in terms of solving the real problem. The real problem is nothing to do with what you see. The real problem is what is going to happen in the future if we don't figure it out. And it's all about Medicare. And if you're 50 years of age or younger, you should care a lot about this, because this program will not exist if we don't get a grip and try to figure out how to reform health care. And it doesn't require, the problem for most Americans is they hear this story and they think, oh my God, do we have to get rid of Medicare? What's going to happen to people when we're over 65? We're not talking about cutting Medicare back now. What we're talking about is a need to try to prevent a program that's going to be exploding. So the Congressional Budget Office says federal health care spending is 5% of GDP today. It's going to go to 20% of GDP in the next several decades. If we don't do anything, the size of the government would double. The American public's not going to tolerate the tax burden they would have to bear to accommodate that. That's why it's important to get a grip on this. It's true that earnings momentum, what preoccupies Wall Street analysts, matters, but frankly, I'm more interested in the elephant in the room. The fact that profit margins are off the charts, have been moving that way for the last 15 years, and no one's really come to grips with this and what it means. And it's the reason, by the way, when Congress is bothering Bernanke about is the stock market a reflection of bubbles that are building? Bernanke's instinctive answer is, well, wait a minute, but the stock market's not expensive. And it's related to this earnings story. I'll show you a picture about this. It's true that leverage from the housing debacle would be a noose around consumers' necks if there hadn't been such an explosion of strategic defaults. It's true that the European Monetary Union puts a straitjacket on a very diverse region, and to many people doesn't make sense, really. But I think to understand Europe, we need to respect the scars of history. It's not just about economics, it's also about history and politics. Wars that altogether destroyed 100 million people from the time of Bismarck to the Second World War. I think if we had experienced this, I think it would definitely leave a mark on the way we think about our own economy. It's true that the Fed's policies punish savers and folks who are retired, but you have to ask yourself, what if we had no central bank? What would the interest rate market look like? If we went through a cycle like this, it would take much longer to get out of the hole that we're in. It's pretty clear to me that if we had no central bank doing what it's doing, retired people probably would be taking a bigger hit. And so we see the Fed as the culprit here, creating our pain. But as Ben Bernanke tells us, if he gets it right, and he's successful in getting the economy back on its feet, keeping inflation low, it is too low right now, by the way, that is going to do a whole lot more to help savers and retired folks than a policy that did nothing and looked the other way. So I think, you know, when I listen to the national debate that's going on, I think there's a lot of confusion. I think the problem is we need to look at these issues in broader terms, and we need to remember that we live in democracies, and when we have lots of pain, if we're not careful, we can vote for measures that actually do more harm than good. And that's what we sometimes forget when we do economic analysis. Now, quick question. On your tables, I left a one-page summary on the sequestration issue. Just a couple thoughts about it. You're hearing all kinds of gloom and doom about what's going on here. When I was in Washington, we've been through this several times, and when I was in Washington, they used to threaten to, every time we run into an event like this, they threaten to shut down the Washington Monument. Well, the Washington Monument is already shut down, so you can't do that. So now you're going to have to wait longer at the airport because they're threatening to cut back on the TSA lines. I think the thing to remember about the sequestration is, you know, they tell you we're going to cut $85 billion this year. The CBO tells you this is going to hit the economy by 0.6%, to slow growth down by 0.6%. But no one ever tells you what's the starting point. And I think if you think about what's going on here, were there no sequestration, and it's not clear to me that we're going to have this yet. I mean, we may for the next several weeks, but it's not clear to me that either side really likes what they've agreed to. My guess is we'll find a way to wiggle out of this. But the truth is, if there were no sequestration, government spending this year would grow about 3%. That's what that top line shows you. That top line on the table is showing you what would be without the sequestration agreement. And by the way, that compares with what happened last year. Government spending declined. And it's all related to unwinding the fiscal stimulus. The sequestration, what it does is it slows the growth in government spending this year. So yes, it will be slower than it would have been if it goes through, but it's not like government spending is being chopped down. Government spending would still grow about 0.5% this year compared with last year's decline if the CBO is right. These are CBO numbers, by the way. So I think the second point is that when you look at forecasts, when you look at economic forecasts, let me show you. I've got by the way, fairly extensive package here. You can have it. You can look at it. Just gives you more color on the fill in the lines. I'm just going to go through 2 or 3 pictures for you to highlight things that I think are important. This is a forecast. This shows you GDP growth in the U.S. The vertical line is where we are to date. The economy has been growing real slow. It's growing about 2%. What I'm showing you on this picture is three different sets of views, and they kind of capture most people's views about this year. The line that's dropping off or slow is CBO's forecast. The shaded area is the range of forecast by the Fed. This year, the assumption is we grow 2 to 3%. The yellow line is my forecast. I think this year is going to be a better year than last year. And I think the point is there is a lot of uncertainty about right now. There's uncertainty about what the economy is going to do, and it's all about this, how much emphasis you put on this sequestration issue. But I think the other thing that's going on is people tend to assume, we've all been kind of disappointed. The growth rate's been fairly slow in the last couple of years. People kind of assume that, well, this must be a sign of the times. It must be that we're on a slow track. And I think what I want to emphasize, the reason for the more optimistic view is I really think there's a lot in motion here, and that a lot of the things that have been holding us back for the last couple of years are really clearing. And as I look at the U.S. economy, I don't see a whole lot wrong anymore. It seems to me like we ought to be feeling like there's a burst of energy coming. And I think the important thing is we may disagree about how to think about this year. Is it going to be more of the same, or is it going to be a little faster? But I think the thing is, this picture shows something that most of us economists all kind of agree to, that eventually we're going to get a much faster growth pace. And frankly, it isn't irrelevant that the Fed tells you that this is what it needs to see before it would even consider backing off on interest rate policy. So I personally like to start with the stock market, because that is what you and I collectively think, not necessarily what we say, but it's what we think. I mean, I learned when I was growing up in the trading world, you learn to listen to what people say, but frankly, I've learned over time that what people do is very different from what they say, because I would hear these opinions, and I look at the positions folks have, and they're totally opposite. So I always like to look at what's the market pricing, what are the views that are in the market, and basically what you see here, the U.S. stock market, the black line, everybody else, the rest of the world, the line below there, we've fully recovered the losses from the recession. So if you flip on CNBC, you'll hear, well, it's all about the Fed. Fed's got rates at 0. Of course, the stock market's flying. Well, you know what? This Fed story is not new. This has been known since March of 2009. When we saw the Fed, when we thought the Fed had run out of ammunition, we saw them come in with this idea of buying assets. It was pretty clear what the Fed was going to do and what they could do. And I personally think we equity investors don't buy stocks just because of what the Fed's doing. If the Fed got rates at 0, but I don't see any sign of improvement in the economy, I'm not buying stocks. I'm only buying stocks if I see evidence that something is happening. And I have to tell you, this is probably, of all the pictures I could show you, I think the most important, because it's got a lot of big stories in it, is this picture right here, which shows you after-tax profits of American companies as a percent of GDP. It's mind-boggling if you think about it, because to me, I've always learned from school days, if you're trying to figure out is the tide coming in or not, what you need to do is figure out what is the chemistry in the business community, because these cycles, we call them business cycles because they're all about business. So when times are good and we're optimistic, too optimistic, you see warning signs popping up, margins start getting squeezed, and you'll notice in the picture, before we fall into recession, the vertical bars, margins are always getting squeezed. So here we are, we went through the 2008 crisis, margins got crushed. What do? We go in survival mode. The business community works real hard to get itself healthy again, and that's exactly what they've done. They managed to restore profitability to all-time record highs. And what that tells me as an economist is the game has changed. If you are earning all-time record margins, I know that there's a powerful incentive at work in the business community to think forward. And this is why you're seeing capital spending growing. There was a moment when it died off last fall, but capital spending has been growing double-digit rates. It's why the job market for young people coming out of college since 2008, which was very closed to those folks, is beginning to open up. On the margin, people who graduated in 2008, 9, 10, 11 are seeing the market opening up more than any other age group, and it's because they were shut out. And that's a sign that business community is moving from defensive mode to offensive mode. You have to think about your staffing needs if you know that if this is what's going on with you, because you know something big is happening and there's a powerful incentive to be thinking about expansion. I think the bigger story, frankly, and it's a huge story for anybody who's interested in growth and what the future looks like, to me this picture is the face of globalization. And it goes like this. We haven't really got our hands around this, but it goes like this. If sleeping giants woke up a while ago and decided they were going down the wrong path, and they needed to get moving. And they decided to do this not organically, but do it by opening up their borders, inviting the world's business community to come there, build an operation in Beijing, employ their people, bring the goods back to the U.S. Anybody who's on the front lines of that story is going to be benefiting. And that's what this is. This is the front lines of that story, because if you want to invest in the China story or the India story, you buy American companies, because they are participating in a story that's unfolding right all around us as the Asian region goes through an industrial revolution where half the world's population lives. So very significant event, and I think that's what we're seeing echoed in this story, which is why, yes, we went through a very bad time, but the business community got back on its feet very quickly, and meanwhile, this story is still unfolding. And if you want to know where we are, the way I think about this is I look at the living standard of China and India. It's kind of where we were in the late 1930s. So what it tells you, $5,000 to $10,000 per person, where we are about $40,000 per person. So what it tells you is we're in the first inning of this story. And I don't know what it means for this. But this is, by the way, this is one reason why folks like Ben Bernanke, who is not an equity strategist, will tell you he doesn't see why the equity market is all that expensive, even though the markets come back fully. Now, let me just run through a couple things why I think it's over. First of all, the housing nightmare is over. And it's over because builders have been underbuilding for the last couple years. Inventories are back down to something more normal. House prices have come back. We've corrected the inflated conditions everywhere. House prices are as affordable as they ever are relative to income. If you bring in the interest rate story, houses have never been this affordable. So what that means is this is the reason why house prices are settling down and they're beginning to rise, because we've corrected the inflated condition. The rise in house prices is beginning to change the mind of that generation that has not yet thought about buying. You ask people in their 30s, are you thinking about buying? No, because I saw my parents' house go down. But this story is changing their mind, because what they're realizing is that as prices rise, it's reminding everybody that really the problem in the last several years, well, we got very inflated, and we've corrected that, and that's why prices are beginning to move. And the generation that's 25 to 35 is starting to find jobs. And what that means is I sort of think for young people who've been graduating in the last several years from college, I think of them as sort of a mini version of the baby boom phenomenon. They go to school, they think they're going to get great jobs, they come out, they can't find a job because everybody's frozen with fear trying to survive. And so what they do, you might want to get married, but you can't really start a household, a family of your own, until you have a job. And so you live with parents, you're doubling up. There's about 3 million people in this situation. That represents tremendous pent-up demand for the real estate sector, which is what we're going to see play out over the next several years. So this is why you're starting to see things happening in the real estate market. We've really corrected the excesses and got them behind us. And you know what's interesting? You go to LA or to Miami, and you'll hear the same story. Prices are rising, things are moving very quickly, and building activity is picking up. So even in the markets that were ground zero of the real estate debacle, the local economy is improving. California has recovered 40% of the jobs that were lost in the recession. Same for Florida. For the national economy, we've recovered about 63% of the jobs that were lost in the recession. So that tells you that even in the brutalized markets, the fact that things are happening in the housing market means this nightmare is getting behind us. And this is a big deal because housing, we've never had a recovery that did not have a recovery in the housing industry. Usually, you get about a half a point to a full point of growth from the housing recovery, which we've not really had until very recently. And this is one reason why this is something that's in motion. So something that was kind of neutral last year should be giving us a lot more growth this year and into next year as the housing industry gets back on its feet. And all that building, all those folks who didn't buy in the last couple of years, they are going to need to buy because they don't want to live with parents forever. So, you know, as they get jobs, they're going to be launching on their own. And